Launch sequence activated. 3, 2, 1.
Is this your homework, Larry?
Ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
All right, welcome to chapter 4. This chapter is going to be all about price action and chart patterns. It's really the main way that we predict certain types of price breakouts, when to get in and out of trades, how to find targets, and really how to predict those perfect entry prices that you might see us getting in the group. Everything that we do that really kind of sets us up for prime opportunities in trading is really built on this chapter. So everything is going to be about these patterns, and these patterns really tell a pretty grand story, not just about what price action is doing, but really about market behavior, market psychology, different cycles the markets are in, sentiment, demand, supply. Really everything you need to know can be seen and told through different price patterns we can see on the chart. Now, this chapter is going to be filled with a ton of material, so you may have to go through it a couple of times. That's not a big deal. The more repetition you have of this, the better. And I really think it will help out your trading in the long run. So with all that said, make sure you go back and review how to draw trend lines and identify a trend. It's going to be very crucial as we work through chapter 4. Also, don't worry so much about the indicators and oscillators at this point. All of that will kind of culminate in chapter 5 and 6, where we put it all together and kind of go over how to forecast price action and how to put it into a pretty sound risk management strategy. With all that said, let's get into it. Let's go. There are many different ways to analyze the financial markets using TA. Now, some traders will use indicators and oscillators, while others will base their analysis only on price action. Candlestick charts present a historical overview of prices over time. The idea is that by studying the historical price action of an asset, recurring patterns may emerge. Now, candlestick patterns can tell a useful story about the charted asset, and many traders will try to take advantage of that in stock, forex, and crypto trading markets. Now, some of the most common examples of these patterns are collectively referred to as the classical chart patterns. These are some of the most well-known patterns out there, and many traders see them as reliable trading indicators. Now, why is that? Isn't trading and investing about finding an edge in something that others have overlooked? Well, yes, but it's also about crowd psychology. Now, as technical patterns aren't bound by any scientific principle or physical law, their effectiveness highly depends on the number of market participants paying attention to them. You might have heard of a self-fulfilling prophecy when it comes to trading. The concepts of trading these chart patterns are exactly that. We are looking to, again, take advantage of crowd psychology to give us an edge and find places of entries and exits in our trading. Now, let's go ahead and get started on some of the most common chart patterns that we can trade to make a profit. So flags. So a flag is an area of consolidation that's against the direction of the longer term trend and happens after a sharp price move. It looks like a flag on a flagpole, where the pole is the impulse move and the flag is the area of consolidation. Flags may be used to identify the potential continuation of the trend. The volume accompanying the pattern is also very important, and ideally the impulse move should happen on high volume, while the consolidation phase should have lower or decreasing volume. The bull flag happens in an uptrend, follows a sharp move up, and is typically followed by continuation further to the upside, versus the bear flag that happens in a downtrend, follows a sharp move down, and is typically followed by continuation further to the downside. Another one is the pennant. The pennants are basically a variant of flags where the area of consolidation has converging trend lines more akin to a triangle. Now, the pennant is a neutral formation. The interpretation of it heavily depends on the context of the pattern. Triangles. A triangle is a chart pattern that's characterized by a converging price range that's typically followed by the continuation of the trend. The triangle itself shows a pause in the underlying trend, but may indicate a reversal or a continuation. And there are some identifying characteristics of these triangles that we can use to our advantage to give us an insight into whether the pattern is going to continue in the trend that it is currently in, or if it is going to reverse in the opposite direction. Now, the ascending triangle. The ascending triangle forms when there's a horizontal resistance area and a rising trend line drawn across a series of higher lows. Now, essentially, each time the price bounces off the horizontal resistance, the buyers step in at a higher price, creating higher lows. As tension is building at the resistance area, if the price eventually breaks through it, it tends to be followed by a quick spike up with high volume. As such, the ascending triangle is very much a bullish pattern. A descending triangle. Now, the descending triangle is essentially the opposite of the ascending triangle. It is the inverse of the ascending triangle. It forms when there's a horizontal support area and a falling trend line drawn across a series of lower highs. In the same way as the ascending triangle, each time price bounces off of the horizontal support, sellers step in at lower prices, creating lower highs. Typically, if the price breaks through the horizontal support area, it's followed by a quick spike down with high volume. This makes it a very bearish pattern. Symmetrical triangle. Now, the symmetrical triangle is drawn by a falling upper trend line and a rising lower trend line, both happening at roughly an equal slope. Now, the symmetrical triangle is neither a bullish nor a bearish pattern, as its interpretation heavily depends on the context, namely the underlying trend. Now, on its own, it's considered to be a neutral pattern, simply representing a period of consolidation. Wedges. Now, a wedge is drawn by converging trend lines indicating tightening price action. The trend lines in this case can show that the highs and lows are either rising or falling at a different rate. It might mean that a reversal is impending as the underlying trend is getting weaker. A wedge pattern may be accompanied by decreasing volume, also indicating that the trend might be losing momentum. So a rising wedge is a bearish reversal pattern. It suggests that as the price tightens up, the uptrend is getting weaker and weaker and may finally break through the lower trend line. A falling wedge. Now, the falling wedge is a very bullish reversal pattern, and it's very common. It indicates that tension is building up as price drops and the trend lines are tightening. A falling wedge often leads to a breakout to the upside with an impulse move. Now, double tops and double bottoms. These are very important patterns to master, especially if you are trading Bitcoin in this bull market. Double tops and double bottoms are patterns that occur when the market moves in either an M or a W shape. It's worth noting that these patterns may be valid even if the relevant price points aren't exactly the same, but close to each other. Now, typically the two low or high points should be accompanied by higher volume than the rest of the pattern. So a double top. A double top is a bearish reversal pattern where the price reaches a high 2 times and is unable to break on the second attempt. At the same time, the pullback between the two tops should be about moderate. The pattern is confirmed once the price breaches the low of the pullback between the two tops, also known as the neckline. Now, the double bottom. The double bottom is a very bullish reversal pattern where the price holds a low 2 times and eventually continues with a higher high. Similarly to the double top, the bounce between the two lows should be moderate. The pattern is confirmed once the price reaches a higher high than the top of the bounce between the two lows, crossing the neckline and moving to higher highs. Head and shoulders. Now, the head and shoulders is a very, very common pattern, and they go in both ways. The head and shoulders is a bearish reversal pattern with a baseline or neckline and 3 peaks. The 2 lateral peaks should roughly be about the same price level, while the middle peak should be higher than the other 2. The pattern is confirmed once the price breaches the neckline support. So, inverse head and shoulders. Now, as the name suggests, this is the opposite of the head and shoulders pattern. and as such it indicates a bullish reversal. An inverse head and shoulders is formed when the price falls to a lower low in a downtrend, then bounces and finds support at roughly the same level as the first low. The pattern is confirmed once the price breaches the neckline resistance and continues higher.
A cup and handle pattern on a bar chart shows a trend in upward performance that trades down and pauses before resuming its upward direction. It starts when a stock's value peaks. The stock incurs selling pressure and descends about a third of its initial high point. The stock then trades near flat levels for a time, forming the U-shaped bottom of a cup. A V-shaped bottom indicates the stock reached a low point, then quickly recovered. The stock eventually ascends smoothly to a point that nearly matches its previous high, then continues to form the handle. Handles usually last less than a month. They can be in a straight line or descend up to a third of the gain of the cup's right side. A move up usually means the stock's upward trend will resume. Trading volume dries up on the decline, remains low in the base of the cup, and increases as the stock ascends. Strong volume is a clear sign that the upward trend will continue. A cup and handle pattern may take anywhere from 7 to 65 weeks to develop, but the form is always the same. The pattern has historically preceded large gains in many stocks.
Now, classical chart patterns are among the most well-known technical analysis patterns. However, as with any market analysis method, they shouldn't be viewed in isolation. What works well in a particular market environment might not work well in another. So it's always good practice to look for confirmations, meanwhile exercising proper risk management. All right, that is our introduction to price patterns. Let's go ahead and move on to some examples of these very important patterns.